Hello there, you're watching Global Business Africa from the Kenyan capital, Nairobi. Over the next 30 minutes, we'll give you a rundown of all the key business stories you need to know about right across Africa. From Cairo to Johannesburg, Lagos and Nairobi, we've got you covered. Here's what's coming up. Air France suspends flights to West Africa as Ebola threatens to isolate some countries in the region. President Jacob Zuma meets his Russian counterpart as part of efforts to strengthen trade ties. And we'll have the details on a popular South African soap opera that's turned into some real-life drama. Let's start in the logistics sector tonight, where Air France is the latest carrier to suspend flights over the Ebola outbreak in West Africa. The French carrier said it would be suspending flights to Freetown in Sierra Leone from the 28th of August, but it will continue flying to Conakry in Guinea and Lagos in Nigeria. France has urged its citizens to leave Sierra Leone and Liberia given the health situation in both countries. The Ebola outbreak has killed more than 1,500 people so far. There's no vaccine for this viral hemorrhagic fever, which causes symptoms like fever, headache, vomiting, diarrhea, and in its later stages, fairly heavy internal bleeding. The International Civil Aviation Organization said this month that the risk to passengers becoming infected on flights is pretty low, pretty much the same thing the WHO said. Regional authorities, however, have put in place special screening mechanisms.
Only the airlines that are still operating in Sierra Leone are Air France and Brussels Airlines. And I want to encourage these airlines to continue their operations in Sierra Leone. For now, they are our last hope. And they are giving confidence to people in Sierra Leone as well as to outsiders that the situation is being put under control and that their lives are not at risk.
Now, the South African President Jacob Zuma met his Russian counterpart Vladimir Putin on Thursday, ending speculation about a trip which has been described as one shrouded in mystery in South African media. The two leaders discussed the November meeting of the Joint Intergovernmental Committee on Trade and Economic Cooperation, as well as efforts to expand trade and investment ties between the two countries. South Africa is looking for new and expanded markets for its fresh produce, especially fruits and veggies. Russia, on the other hand, is facing an array of sanctions from the West and its European neighbours, and it's looking at other regions, including Africa, to get its supplies from there. Zuma has been in Russia since Monday this week, but his itinerary had not been publicised. Ostensibly, according to his handlers, this was to allow the South African president 2 days of rest. Now, speaking of South Africa, the world #2 platinum producer Impala Platinum has launched a strategic review that could include a shift to mechanization and resultant job losses in its South African operation. Now, the company is just coming right out of a 5-month strike that affected operations at its Rustenburg mines, costing it 320,000 ounces worth $450 million of output at current spot prices. The company also warned of tough times ahead on the cost front as it struggles to ramp up production and it rolls out pay hikes of up to 20% to its staff. Its chief executive, Terence Goodlace, told journalists in a conference call that the results of the review will be unveiled in December and they might not entail job cuts. Job cuts, of course, are a fairly thorny issue in South Africa, where the unemployment rate is over 25%. And in the Platinum Belt, they could trigger new strike calls by the Association of Mine Workers and Construction Union. Now, speaking of South Africa, its manufacturing sector shed some 59,000 jobs in the second quarter of this particular year. Now, this, of course, is a fairly dismal development, and it follows unstable labour relations, weak consumer demand and slow government involvement. As a whole, the sector dipped 0.3% in the same quarter. Since 2008, South African manufacturing has cut 250,000 jobs as it struggles to generate jobs for millions of South Africans. Most manufacturers say the biggest headache is the rise in the cost of production that's eating into their profits and competition from overseas as well. Analysts are proposing a series of measures to turn the sector around that include better government policies, trade promotions, more investments in infrastructure and cutting quite a bit of red tape as well. Now then, let's move on to Johannesburg, South Africa, especially to focus on the results from Implat's Angelo Coppola is now with us from the city right now. Angelo, Implat CEO argued that costs in 2015 are, and I'm quoting him here, not going to be pretty. End of quote. Now, is that mostly due to the wage deal that it arrived at with AMCU, or are there other cost items that we're not looking at here?
Well, the bottom line is that AMCU wage increase is probably going to be unsustainable over the long term. All the analysts have been saying the same thing, and it's probably going to be the major impact next year. But let's also bear in mind that the price of ore, that platinum basket of ore that they pull out of the ground, is also at average levels right now. It has to spike a bit to make those shafts a little more productive. But for now, it's really to do with the AMCU wage negotiation and to do with the flat metal prices in the platinum sector. Rama?
Indeed, but Angelo, this isn't just a question of digging stuff out of the ground. So to what extent can Implats, and by extension Lonmin and Amplats, mechanize their mining operations and cut the reliance on migrant labor?
Well, let's turn the question around slightly. The migrant labor issue is being addressed by a task team that's been set up by the Chamber of Mines and the Department of Mineral and Resources. So we can assume safely from that migrant labor that's within the region and within South Africa is going to continue. The fact is that you can do some mechanization of mining. They've been testing water as a means of getting those stope operators away from the stope face to try and make it safer so that less people have to go down underground. But in essence, they can't mine those shafts in a mechanical way because the ore body is too narrow. So you've got a trade-off here. They have to do a bit of mechanization, but they can't do a lot of it.
Indeed. With all this talk about restructuring, however, is AMCU still firmly opposed to any job cuts at all in any of the top 3 platinum miners?
Well, for the answer, you have to look back to what happened over the last 5 months from when the strike started. They were adamant, AMCU was. They stuck to their position. They stuck to it right until the end. They haven't at any point indicated that they are going to take any kind of retrenchment announcement lightly. In fact, I recall in June having spoken to the organizer at one of the top 4, and he said if there's any retrenchment, and this was in June, they would go back on strike. So at the moment, AMCU aren't indicating either way whether they will or won't take retrenchment as an option to keep those particular mines and shafts open right now. Raman?
Indeed, but the fact of the matter is, Angelo, the writing is on the wall here. We're seeing falling earnings from all the top 3 platinum miners. Amplats, of course, is disposing of some of its assets. And Lonmin earlier this week had to deny reports of a 21% reduction in its workforce. Now, based on that experience and the numbers we're seeing from these companies, how should platinum miners proactively communicate with unions and government about any future job cuts?
Well, whether there's any truth to that announcement earlier in the week is neither here nor there. There's certain kind of legal processes and labor law processes that the employer has to follow in terms of informing the employee. So if there's any announcement via the media, you can bet your bottom dollar that AMCU and its leadership will down tools, and we'll probably go back to the strike situation we had before. So they have to follow a process. We know that from the previous announcement, there were 2 sources that indicated separately that there were job cuts in the offing, but there's been no labor law announcement or letter to the AMCU letting them know that they're going to be entering a restructuring process. So that's the process that they should be following. But look, there's still negotiations and discussions happening between AMCU and the employers, and it's hoped that at that point they'll start sharing whether they need to restructure and what will happen if they don't restructure.
Indeed, we'd certainly live in interesting times. Angelo Koppler there live in Johannesburg. Let's move on to the World Bank and some data from it. It's cut its 2014 growth forecast for Rwanda. It essentially blames delayed spending on energy and transport, as well as a slowdown in credit growth to the private sector for that revision. Growth in the East African nation is projected to be just 5.7% in 2014. That's down from a prior forecast, almost 200 basis points higher at 7.2% that the World Bank had given in December last year. In its annual budget, Rwanda projects that gross domestic product will grow by 6% this year. That's the same growth projection given by the IMF, helped by the expansion in the agriculture, service and industrial sectors. This country of 11 million people has been attracting a steady stream of investors and firms drawn by a small but growing market that does welcome foreign investors. Quick run through the equity markets here for you just before our first break. A fairly interesting development from Kenya. KQ shares, of course, are recovering from the lows of around 950 that drove the market on Wednesday. Today, though, it was KPLC that was one of the more heavily traded counters. The results are coming out sometime next month, so we're seeing quite a bit of position taking over there. In reference to the platinum stocks, of course, off our discussion with Angelo over there, they dragged the JSE much lower. Implats down over 5%, Amplats and Lonmin down by well over 200 basis points in trading today. Coming up next, we'll be looking at Kenyan horticulture. It's going to lose preferential access to the EU. And we'll be digging into the performance numbers of the regional oil marketer KenolKobil with its managing director. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies.
From small businesses to large-scale enterprises, hear directly from entrepreneurs behind the story. It's about putting you in the picture so you know where Africa fits in the global context.
Global Business, weekdays at this time on CCTV Africa.
We do know that the strike isn't anywhere near close to coming to an end either. That means that those workers are going to sink even further into poverty.
On the 28th of August, you're watching Global Business Africa. Thank you for watching. Now, the Kenya floriculture industry is almost certain to take a hit of about $130 or so million in October when the EU slaps a fairly punitive 10% import tax on cut flowers and similar products from Kenya. The tax is a direct result of the delay in signing an economic partnership agreement between the two countries. Kenya, or rather the two partners, Kenya on one hand and the EU on the other. Kenyan flowers at the moment enjoy quota and duty-free access to the EU, and that story makes our What's Hot segment tonight.
With the deadline to pen the economic partnership agreement set to expire on October the 1st of the year 2014, the Kenya Flower Council says it's almost certain that the horticulture industry in Kenya and the floriculture sector in particular will have to bear the brunt of a new 10% tax in the European Union as Kenya loses its quota and duty-free status. Richard Fox is Sustainability Director at Finley's, a major Kenyan cut flower producer and the chairman of the Kenya Flower Council.
Even if the agreement is signed or an alternative arrangement is reached, it takes time to ratify that process, ratify that document through the European Council and Parliament. So almost certainly the horticultural exports from Kenya will be subject on average to about 10% duty into the EU from the 1st of October.
The negotiations have been nearly 8 years in the making, and with the East Africa community negotiating as a bloc, the negotiations have proceeded slowly.
And so we have to wait until everybody is on board, everybody is comfortable with that language. That has been the problem. But we are closer today than we have ever been.
In the year 2013, Kenya's total exports amounted to some 478 billion shillings, or just over $6 billion. Of these, exports to the European Union comprised 22%, or 105 billion shillings, or just about $1.3 billion. 83% of all exports to the European Union, about 95 billion shillings, were mainly cut flowers, fruits and vegetables. In all, the industry is estimated to support over 2 million Kenyans, thus underlining its importance.
It is crucial from the floriculture and the horticulture industry and also other exporters into the EU that the government is able to conclude these negotiations on the best terms possible for Kenya because it will secure our duty-free and quota-free access in the long term.
For now, though, the low cloud of uncertainty hangs over the industry, with many unsure whether to continue investing or whether to take a conservative approach. The application of the duty simply means that Kenyan goods become uncompetitive on the market.
The extra cost of duty has to be absorbed somewhere, and that is an amount which the country can't support, the industry can't support. If the EPA is signed and then we get some clarity on how long the ratification process would take through the EU, then we would have to look and see what assistance government can give us to cushion the effects until the duty-free and quota-free relationship is reinstated.
And with just over a month to go before the deadline takes effect, a flurry of activity between government, industry and the European Union is expected in order to make a last-ditch attempt to resolve the situation. What fruit these efforts will bear, though, remains to be seen. Peter Okaba, CCTV.
Now, the regional oil marketer KenolKobil has reported a 299% jump in the first half pre-tax profits that it attributed to a cost-cutting drive. Now, the company has operations in Kenya, Uganda, Tanzania, Rwanda, Zambia, Ethiopia, Burundi, Mozambique and the DRC. And it says profits to the end of June were up to $9 million. And this, of course, comes after the company cut financing, operating and staff costs as well. KenolKobil was recently forced to scale down an expansion drive after an acquisition plan by Puma Energy fell through. The company reported that its cost savings were strong enough to cushion its exchange rate losses. KenolKobil has also cut its workforce by at least 41%. David Ohana is a Group Managing Director of KenolKobil. He's with me in studio right now. Thank you for your time this evening.
Good evening.
Always good to have you here. You argued when you released your first half results that the operating environment has been challenging, but from an outsider's perspective, Oman crude prices have been going down, Brent crude has been moderated, of course, by rising supply from Libya and elsewhere. So when you say the operating environment is challenging, what exactly are you referring to?
Yeah, first for the Marban, we need to put the facts correct. The Marban as of today, it's at $105 per barrel. Generally, the oil prices are in a downtrend. Over the last year. Yeah, it was a seesaw during the year, but being an oil company, you'll always have stocks.
Yeah.
And you know, when the future prices, and we saw it in Kenya, we saw the pump prices coming down, probably not as the public was expecting, but remember we have the aspect of the exchange rate, which is holding us when the shilling is depreciating. But generally, over the year, oil prices were coming down. And us active in the market and big market share, we were always forced to keep inventory. Inventory for a company like us, it's a big thing in terms of contribution to the bottom line.
Because you're always buying these on a forward contract basis.
Correct, correct. And you have formulas which have been set in advance. So if you keep stocks long in a market which we call backwardation market, and that's what's happening in the last 1 year, the future prices are lower than
Which
the
essentially
current.
leaves you under the water, doesn't it?
Again?
It leaves you under the water because essentially you're taking losses here.
Correct. So I think we did a lot in this regards in this first half results. We managed the inventory in a smart way. And the results, as you mentioned, close to 300% increase. And we are quite happy. The other aspect that was volatile, remember we are operating in the all countries, in the 8 countries we are in high-level interest rate regime. In Kenya, it's a big issue still. So it's impacting our financing cost. And the third one is the exchange rate. Look, the shilling is keep depreciating to the dollar. And again, it's not only in Kenya, it's all over the countries. So it's an environment which is more challenging than, you know, if we were operating with lower interest rates.
Because essentially you have to now juggle your exchange rate exposure, your credit risk and so on across 8 different operating territories.
Correct.
Let's move on to something else, however. You've got at least, as far as I can remember, 10 different business lines. But let's narrow down on 3 of them: export, aviation, trading. In your last financial year, these all posted losses. Is that still the case, or have they turned around?
Yeah, export, over the years, it's a profitable business. Aviation, you are right. Aviation, we turned it around to profitable. We are happy. We are selling close to 20 million liters as of today. British Airways, Lufthansa, our customers, KenolKobil. And we are quite happy with the aviation. It's contributed nicely to the bottom line of the first 6 months. Trading, I'll tell you, we are more selective. Trading, it's huge volume, while very slim margins and big exposure to the currency, to the dollar. So we just delivered in July. The jet was an emergency cargo of jet. Kobil won it, and successfully we delivered it in July. So we are still in this segment, but the board and the management more cautious. When the margins are too low, we are not touching.
You're not interested. Would that then explain that shift that we saw in its contribution to sales? Because I remember in 2012 fiscal year, it was about 56%, give or take, and then that drops to about 7% or so.
You're right. You're very right.
Okay. Except for Burundi, you cut your staff right across the board, fairly drastically. I mean, 46% down in Kenyan manpower. Is this aspect of the restructuring over? Should we expect more cuts?
You know, it's the most favorite question in all interviews I'm going, and I'm talking to my staff and to you and to the investors. There is no job cuts in KenolKobil. It ended last year. around October last year. Actually, we were busy recruiting staff, again, not to the levels that were in the past. What the management and the board is focused now is the guys that, and generally the employees across the countries. We are around 330 employees now, across the 8 countries. We are focusing on their welfare and developing their skills, training them, and developing their careers. So there is a special focus on the employees themselves. And I think KenolKobil over many years was a great employer. That's what we are busy doing now, building the confidence of the employees and by extension the investors in our shares.
Right, so let's get into the nitty-gritty details of your balance sheet here. Your interest coverage ratio was just about 1.51% in the last fiscal year. What's your plan for getting that up moving forward?
Good question, by the way. The first half of 2014, we closed with 2.8 ratio, and we are working, and I'll explain how we are doing it, to achieve 4. I see it happening I wish it will be at the end of this year. Maximum it will be at the end of first quarter 2015. And simply the focus is to stay profitable, focus on business lines like lubricants, LPG,
the
retail,
ones.
Correct. And this is what helped us to bring the GP to 6.1% in the first 6 months. So long we stay focused, we'll be humble, we'll respect our customers, and we'll stay, board and management, focus on doing our things right. We'll be profitable with that money that we'll make. We'll be able to pay debt. By paying debt, you'll increase your ratio. And by that, actually, you simplify the processes that complicating when you are in high debt, which, if you see the 6 months results, came down by almost 3 billion, which is substantial.
Just still on that interest rate question, because with regard to the average commercial retail lending rates, between June 2013 and June 2014, it only went down from about 17% to an average of 16.4, which, strictly speaking, is still fairly high. Now, for you as KenolKobil, because a lot of your debt is very short-term, it's payable in less than a year, how do you manage your credit rating, your interest rate exposure, rather?
Sure. Look, we restructured our loans when I took over. First, we are not only borrowing in the Kenya shilling, so the rates that you were talking about, it's applicable on the Kenya shilling. You are right. There is a basket which we are trying to balance between dollar and Kenya shilling. For example, the stocks we are having, it's in dollar denominated loan, and the normal operations, salaries, whatever we are doing in Kenya, it's in Kenya shilling. So we restructured with the board, we restructured the loans. And look, the simple way we sold assets over the last 1 year in Kenya and in subsidiaries, all the, KenolKobil expanded a lot, and we are a large asset-based company. So we disposed assets. With that assets that are not contributing, we paid debt. And by that, we were able to reduce, and we pay, look, I can tell you the lowest level of interest rate we paid was July, which is not in the 6 months results, so the trend is still down.
All right, we'll have to leave it there, unfortunately, but fascinating conversation as always. Thank you very much for your time this evening. We've been speaking to David Ohana. He's a Group Managing Director of KenolKobil right here in studio. Now, of course, let's make a quick run through commodity prices before we jump into the next part of this particular bulletin. Not directly related to anything you're seeing on your screens right now, but with regard to oil, Kenyan legislators are now thinking about reintroducing capital gains taxes. That was, of course, in debate around the Finance Bill of 2014. Whether or not it will be signed into law by the President is an entirely different matter altogether. We'll keep you posted on Global Business. Now then, the popular South African TV soap opera Generations is preparing for a new look. That's after producers of the show fired its entire cast over a wage dispute that had been dragging on since October last year. Now, the 16 actors were informed last week have vowed to fight back and have accused the producers of imposing, and I'm quoting here, apartheid-like conditions on them. The drama has turned into a real-life soap opera. South Africa is rising unemployment. Sumitra Naidu has more.
7.4 million South Africans tune in every weekday evening for their favorite soap opera, Generations. The soapie has also grown its audience across the continent. Many of the actors on the show have become household names. But by October this year, they will no longer have a place on the soapie. 16 of the actors got the boot last week after they demanded more money.
You know, people are talking about like it's Sophie Ndaba makes 55,000. No, Sophie Ndaba, it's an average figure. Sophie Ndaba makes about 80,000 plus per month. Okay, the same thing applies to those people like that guy who says that the money I pay him is dog food money. That guy makes about 75,000, you know.
The cast say they have been trying to negotiate with the SABC and the production house, but there's been no cooperation.
We have agreements in principle. We announced it on TV last year in October when the first stay away started. And those conditions, those agreements, the promises were never met.
But Vundla says it's over.
It's over, completely over. We are starting afresh with a new direction in the Generation series, a new cast of characters. It's over.
The SABC has followed suit. The South African public broadcaster owns the rights of the show.
In this particular instance, these actors are employed by MMSV. We as the SABC have a contract with MMSV. Our delivery expectations are with MMSV and not with the actors.
But the cast says it's being treated unfairly and have accused the SABC of employing apartheid-style work practices.
There's a lot we can tell about the refusal to transform the SABC. That it was founded on the principle ya apartheid, a principle that did not recognize South Africans as South Africans. A principle that said there is a budget for white productions and a budget for black productions.
The drama has caused quite a stir among South Africans.
And we want to say to the country that the SABC cannot be allowed to create conditions that condemn black talent to a life of perpetual poverty.
We can never have what they've built. All we are asking for is our share in the piece of the pie.
The actors say they want to meet with the SABC and with Vundla to find a solution. It's not known at this stage whether that meeting will go ahead, but it does look highly unlikely that the cast will be rehired. Sumitra Nadu, CCTV, Johannesburg.
Real-life drama indeed. Now let's move on to something else with a little less drama, the forex market for you. The Kenya shilling was expected to essentially weaken towards the end of the month. Earlier this week on Tuesday, the central bank, of course, did step in, dumped in a specified amount of dollars on the market in order to prop up the shilling. It had gone down to about 88.80 to the dollar. It has demonstrated its willingness to prop up the shilling, but to what extent it can keep doing that, that's a little open-ended. Now, on Global Business tomorrow, we will be looking at Zimbabwe's latest efforts to support its struggling banking sector in a lot more detail. And that's it for this edition of Global Business. If you have any feedback on this program, I certainly hope you do send it to Global Business Africa at cctv.com, wherever you are online. Facebook, Twitter, you name it, we're there. So the news continues 24/7 over there. I will see you in 23 hours. Thank you so much for watching. I'm Ramanya.